Let's bring in Moody's Analytics chief economist, Mark Zandi. It's a reminder, Mark, that tech is just not that big of a part of our economy's workforce because it really hasn't shown up in the broader economic data, which continues to point to a strong jobs market. Do you expect it to make an impact?
Well, it will have an impact, but it's small. You're right. I mean, in the grand scheme of things, I mean, if you look at, we just got a data point today, Sarah, from the JOLTS, that's the job opening labor turnover survey from the BLS, and it said that the number of layoffs in the month of November was about a record low. It's been lower, but rarely in the past 20 odd years that the data has been available. And it's well below what we saw pre-pandemic. So despite the surge in tech layoffs, it's not translating into layoffs economy-wide. The rest of the economy is still absorbing those people that are losing jobs and creating enough jobs to keep layoffs down. So far, so good. It's not translating into any significant impact on the broader economy.
But is that coming next this year?
I would expect it, right? I mean, almost has to by design. I mean, the Federal Reserve is working really hard to cool off the job market, get job growth down to something closer to zero, because they want to see unemployment start to notch higher and get that wage growth back in so that inflation comes back in. So they're going to continue to push, meaning continue to raise interest rates until that happens. So, yeah, I'd be pretty surprised if we don't see layoffs at least normalize, right? I mean, they're well below what you typically have seen. Interestingly enough, the labor market has cooled off a bit. I mean, job growth is definitively slowing, but all of that is because of less hiring, not because of increased layoffs.
I have to give you credit, Mark, because you've been bullish almost in the soft landing camp, at least for several months, especially when all the doomsayers were calling recession, when the Fed really started tightening, triple rate hikes, 4 in a row, inverted yield curve. Do you still think that they can pull this off while avoiding a recession or a very shallow one?
Well, you're very kind. I'll take it. The kind words are, and of course, there's a lot of script to be written here, and the risks are high. I mean, with inflation where it is and the Fed on the warpath, if anything else goes wrong, recession does become more likely. But yeah, I think we have a fighting chance. I mean, we've been getting some reasonably good news here over the last couple of months. Everything from lower oil prices to the end of China's no COVID policy. Feels like the job market's kind of cooperating here more or less. So it feels like everything's moving in the right direction to get inflation back in the bottle sufficiently before the Fed has to push rates up and push the economy into recession. So we need a little bit of luck. Nothing else can go wrong. And the Fed has to get it right. They got to be pretty deft with their policymaking. But yeah, I think we can make our way through. And I'll have to say, even though I think recession risks are high, my baseline outlook, the outlook that the headline forecast that we provide to clients has no recession in it. Slow growth. I call it a slow session, but not a recession in 2023.